Welcome to another episode of The CEO Story. And I'm so excited for this one. Really going to go deep on insurance. We've got a great guest today. Brandon Trammell is fantastic. He's going to teach us how to use insurance as an asset and totally reframe the way we think about insurance. So Brandon, thank you so much for joining us. How are you doing?
Happy to be here, man. Thanks for having me.
We're going to drop some great bombs today. I'm really excited about this. I get asked all the time about this. We speak to so many advisors, financial advisors, insurance advisors, and everyone across the board. But we don't often come across many people with the unique skill set that you have. So it's going to be less about your history, but more about getting into the speciality of what you do.
Yeah.
But let's just start off with a little bit of a background about you. Yeah. Your father, a husband, a lot of great things in between.
Yes.
And let's just get that out the way with, and we can jump straight into the good stuff. So just give us a high level, let people get to know you a little bit, and we'll jump into the meat.
Well, I mean, as you noted, a husband and a father, probably the two greatest accomplishments of my life.
And rightly so, yeah.
Those little girls are just my dream, man. I tell you, it's one of the most rewarding things I get to do every day. So, and I get to do a lot of rewarding things. So I live in a beautiful place, a world destination, wine country, run my practice in collaboration and partnership with amazing people that are smarter than me and better than me, as we've talked about.
That's the best way to be.
That's the way to do it. And so, I'm a fortunate guy, and I get to help people to really structure their personal economies in such a way that they get to do what they want to do, and they get to build legacy and positive impact.
It's really important, right?
It is.
Most people don't really understand the difference between being rich and being wealthy and then creating legacy and that future generational step. So we're going to break all that down for you guys right now so that it's going to be really simple in the steps. So how did you end up in financial services? Let's dig in.
Well, it started in the wine industry. Shocker, right? As I'm in wine country, but I was approached by one of my club members at the time, and said, when you want to, take an adult step after you're done with school, then let me know, and I'll get you a job. And that led into banking, which I really. I appreciated that experience because it gave me practical experience in the industry and a lot of exposure. But what I really found through all of that is that the people are what I cared about the most.
Okay, relationships, yeah.
Serving and supporting them in doing what inspires them, what they need to do. Those are the things that I enjoyed the most. And so as I was kind of looking around, how do I next level the impact that I get to have on people's lives, and how I get to help them? And insurance, investments, financial planning was a very obvious next step for me. And so found my way into that and have just never looked back. Though I've thought about it, and then I realized, no, this is what I really love doing. I love the people and the way I get to serve them. So
you're definitely that type of person. Just from our relationship and getting to know you over the last couple of years, it's people first.
Yeah.
And that's probably what that club member saw initially, is that you took really good care of him. He recognized an A-team player and someone he then wanted to pay it forward and help and develop, which is exactly what we do now, right?
100%.
And then you followed the line. So now let's jump in straight into it, right?
Let's get to the goods.
Yeah, because this is really the top of the line stuff, right? So I'm personally set up with this type of system for myself.
Yeah.
So I do want to share that with everyone. I'm not an expert in it. I don't want to pretend to be. So it's great having you on so you can explain it in simple terms to everyone so they can help understand what it is, but more importantly, how they can use it in their day-to-day lives.
Sure.
So when I generally, before I started doing everything that I'm involved with now with Together CFO and high net worth trust structures, I always thought of insurance as a liability. It's something that I have to pay. Got to get a premium. It's cash flow out, right?
Right.
But as I created more and more wealth and I realized how the elites use insurance as an asset rather than a liability, it really reframed my whole perspective on things.
Yeah.
And again, there's levels to everything, right? So whether it's the most basic plan that's $20 a month or whether it's 20,000 a month, there's certain ways in which we can use these things. And insurance was always really confusing to me because there's so many of them. It's like, holy smoke, which one do I need? And will I do variable? Do I do fixed? And there's all these. It's similar to trusts where there's over 85 different types of trust. Do you need a simple trust or do you need a complex trust? Insurance, I think, has a lot of similarities where you have a whole range of vehicles. It's kind of like eating at Cheesecake Factory. You're just paralyzed. What the hell am I eating? Right. I know I'm going to get the cheesecake at the end. But what am I going to eat as my main course? Right. So help us break down the major categories or kind of the spectrum at a high level.
Sure.
And then we can dig into really what the elites use because that tends to be one subsystem.
Yeah. I mean, you laid out something that I think is a really common conception of life insurance. And I think more accurately, the conception is death insurance, right?
Yeah, actually, that's true.
It's a liability. We pay that premium every month. If we die, then, our beneficiary gets that death benefit, right? Tax-free death benefit, which is true. And it's only a sliver of the pie though, right? As you pointed out, that term insurance is temporary. And then there's permanent insurance, right? And different types of permanent insurance. There's universal life, there's whole life, and even under universal life, there's a multitude of different types, variable or indexed or just straight universal life. So which one is right? And I mean, we could go into the complexities of insurance, but ultimately that adds confusion to something that doesn't need to be confusing.
It's so far over my head. I was like, I don't know. And I ended up just like at my early stage, just whatever you have, just give me this.
Right.
It's like, if I know if you've got it, there's a reason and you know it. So let's just go with
that one. Yeah.
And that was literally my default when I was a W-2 employee and I didn't want to be bothered with reading this illustration of 50 odd pages and I didn't understand any of it anyway. So I was like, I'm just out.
I think there are a lot of insurance agents that don't understand it. I think I saw your head nod a little bit as I started talking about the different types of insurance. It's a sleepy subject if we're thinking about it in that way, but it's overcomplicated unnecessarily.
So how do you simplify it then?
And we were talking just before, right? As I explain it as if they're 5 years old.
Yep.
I wanted to explain, if you can't explain it to me like I'm 5 years old and I would understand that, then you're overcomplicating it unnecessarily. So when we're talking about sort of that next level of how to utilize life insurance as an asset, when you talk to folks who have done well for themselves, they have done a great job of creating wealth and preserving that wealth and growing it. What they understand is that leverage is a very important factor for business acquisition, property acquisition, whatever the case might be. So with a life insurance policy, like a whole life, let's use that as an example because I think it's the most straightforward. It is the easiest to understand because it's not overly complex. And that usually makes for the best outcome. So yes, you pay that premium. And when you die, there's a death benefit for your beneficiaries. Standard like death insurance. But the other component of that is like a savings account inside of that policy. A high yield savings account, let's say. So as you pay those premiums, you can also then put extra money into that policy as well, where we're going to build cash inside of that tool, that very valuable policy. That gives us the ability to leverage that asset for other things while we're alive, to give us leverage for different wealth building strategies, business acquisitions, real estate, that sort of stuff as well.
See, that's the part that most people, it's over the head, it's gone.
Right.
So if we break it down into 4-year-old talk, not 5-year-old talk. Right? We're not graduated just yet. What we're saying is you can put money into a policy.
Yep.
So let's just put some numbers around it.
Sure.
Let's say you put $100,000 a year into a policy.
Yep.
That policy is going to earn dividends. So let's just say I'm with Mass Mutual.
Right.
I'm not plugging anyone, but that's just who I use. Let's say roughly 5% per year.
Yep.
So I'm going to get $5,000 from Mass Mutual every year just for having that policy in there.
Tax-free.
Tax-free. And that's going to be a lot more than the 1% Chase has given me for my money with them.
Guaranteed.
So instantly I'm making 4% more than the bank's given me. I like it already.
Yeah.
But there's more, right? Now, my death benefit could be multi-million dollars. Let's just say $5 million as just so we have a number.
Yep.
So I'm putting $100,000 a year in between now and when I die every single year.
Yeah.
And I'm going to receive $5 million, or not me, but my beneficiaries are going to receive $5 million upon my demise.
Right.
I hate saying that. Nobody really likes talking about death, but that's
just
the reality of it.
Yeah,
right?
we do all die.
There's two things certain in life: death and taxes. Right? We've heard that one before.
Yeah, and we get to deal with both of them. So there you go.
You only die once. You got to pay taxes every year.
That's a true statement. That is true.
So now I'm getting a dividend. And on that death benefit of $5 million, I can take a loan out against it. Obviously not all $5 million, but the amount of what I've contributed in, I can take a big percentage of that and then reuse it on future investments. So let's use real estate just to keep it super simple.
Sure.
I put $100,000 in year one.
Yep.
And if I've got the right trust structure, I get a full deduction for all 100,000.
Yes, you do.
Unlike LLCs, S Corps, and C Corps, where you don't.
Correct.
So now I've got a full deduction. Fantastic. Nobody likes paying taxes. So
we love deductions.
Yeah. So deduction's good. 5% dividend is awesome.
Sure.
Death benefit, unfortunate, but awesome. Big payout for my beneficiaries.
We take care of the families.
And then the kicker, I get to reinvest that money, or let's just say 90,000 just to give optics. So now there's 4 really great benefits of why everyone should use this.
Right.
Why isn't everyone using this?
Well, why isn't everybody using a trust structure and private family foundations?
They don't have a team that knows how to do it, right?
Right.
So in the insurance world, let's equate it to trust, seeing as though we talk about that. So we've got a simple living trust, which is 99% of trust to that.
Yep.
And then it's only the really elite that use the top 1% that use complex trusts.
Right.
What is kind of the ends of the spectrum in an insurance standpoint or terminology?
I mean, and the insurance policy can be owned by either of those trusts.
Not owned, but in terms of what would be a starter package of insurance that you'd recommend someone making $50K a year,
right?
Versus what would someone need that's making $5 million a year,
right?
Like that's kind of the scale I'm looking at.
I think you point out a really important item to consider, and that is that the number of zeros in that policy, in that cash value, is all relative to your personal financial situation. So if you have you make $100,000 a year, you're probably not putting $100,000 a year in premiums towards your policy,
of course,
right? So you're not going to have that many zeros behind your cash value as it continues to accumulate. But it's all relative. It's all relative in life.
Okay.
So if you're putting $10,000 a year, let's say, towards that policy, you're still going to earn that 5% dividend.
It's just on a lesser amount.
It's just a lower amount.
Okay.
But that lower amount is relative to your life, your circumstances, your needs.
Okay. So if I'm understanding it right, then it's not a difference in the tool. It's just how much you fund in the tool. So
Correct.
It's not the car that's different. It's the amount of fuel that you pumped into the car.
Yeah, jet fuel versus regular octane, right?
Got it. Okay.
Exactly.
So there's no barrier to entry in this example. I think you used whole life versus variable life.
No.
Anyone can have a whole life policy.
I mean, as long as you can qualify, right? We qualify for insurance with our health, not our wealth.
Okay.
Right.
Perfect.
So we do have to qualify for those policies. But
assuming that
we're all healthy, there's no barrier to entry. It's all relative to, what your assets and income are.
Super valuable because to work with me, you've got to be paying at least $200,000 a year in taxes.
Right.
just to even have a conversation with me.
Right.
So that eliminates 99% of people.
Right.
And it's only the remaining top 1% that maybe qualify. Who knows? But it's worth a conversation. Whereas in your world, you can literally help anyone.
Sure.
Regardless of if it's 50K a year or 50 million a year.
Correct.
All right. That's really important to know. So
it is.
In the trust, I know firsthand, obviously I'm set up this way, that I get the deductions and I can also MEC policies. Can you talk a little bit about what is a MEC? What does it mean?
Yeah.
And then why can you not do it in an LLC or individually, but you can do it in a trust?
So to clarify, you can do it outside of a trust. You can MEC your life insurance policy outside of a trust, but it has tax implications that you don't have if it's inside the trust.
So now
in your system.
This is back to what we're saying. So this specific advanced strategy within insurance is applicable more so to people that have a complex trust structure because they don't then have to worry about the capital gains of the MEC.
Funding it at that level. So what is a MEC?
Okay,
right?
Let's start there.
So in a life insurance policy, you have certain IRS limits on how much can be put into that policy above and beyond the premium.
Okay.
IRS dictates that because in the mid 80s or so, extremely wealthy people were funding the hell out of whole life policies where basically it was, a tax advantage.
Well, still to this day, like all the billionaires that I hang out with and clients of mine, they all are heavily in two things, real estate and insurance. It's the common string amongst them all. And I didn't get that until I started spending more time around these guys. It's like, hang on, you're doing it, you're doing it, you're doing it. They all have trusts, they all have insurance, they all have real estate. So that's kind of the underlying tricks to becoming wealthy,
It's a tactic and a strategy that the wealthy have been leveraging for generations.
So what happened in the 80s with the whole MEC?
Well, they were funding policies at such a high level that the $1 million death benefit might cost them $5,000 a year, but they're putting $1 million of cash into the policy where the cash value is exceeding the death benefit. So it's in that way, it's not really a life insurance policy, right? It's more of a tax evasion strategy as the government saw it. And so the IRS put these limitations in, right? It's 7702. For anybody who's wondering. But
we'll put the link below.
Very few people are like, what part of the IRS code is that? But anyway, so it basically just states that there's a limit on how much cash you can put into that policy above and beyond premium, depending on or relative to the death benefit.
Okay, that makes sense. Because otherwise you could just get one policy, overfund it, get the deduction, and away you go.
Exactly. Reap all the tax benefits on a life insurance policy for $50,000 it costs you.
But you can still do the same. It's just now multiple policies, right?
Correct.
Okay.
And also you can create a larger policy, right? So one larger policy is going to give you more room, but it's all relative to income and all that. Anyway, the keystone of this is once you pass that threshold that the IRS puts in place for your policy, it becomes what's called a modified endowment contract or MEC.
Okay. Right? Modified endowment contract.
Right.
Okay.
And so what that just means in very simple terms is all those dividends that you're receiving on that cash value are now taxable. So you have to pay taxes on the growth that happens
specifically
in the policy.
Capital gains tax.
Correct.
Okay.
Correct.
Great. Because that doesn't really matter if you've got the right type of trust set up because you can indefinitely defer those capital gains taxes.
Right.
So you can build more aggressive policies, get bigger deductions, and still use the insurance as an advantage in the trust structure.
Exactly. And if outside of the trust, so just to kind of give like a gauge for people, right, is that outside of the trust, you can give about 2 times what your annual premium is into the policy.
So if my premium was $100,000, I could put $200,000 in?
Give or take.
Okay.
Depending.
Yeah.
But general idea. Once we're inside the trust structure, then we can get closer to about 10x, 7 to 10 times what
so
that
now I can
is.
go from a $200,000 additional deduction to a 7 to 10x of that, 700,000 or $1 million of deduction.
Yep.
And then still loan against it, still get the dividend on the whole amount, right?
Yep.
So now I'm getting a 5% dividend of 10 million, let's say.
Right.
So now we're talking some serious numbers.
It's walking around money.
And then I also get to reinvest that as well.
Right. And so where the folks who are leveraging the strategy of this asset, this insurance asset, comes into play is you cannot just leverage it once. You can leverage it, replenish it, leverage it again, do it again and again.
See, I always get confused with this point. So let's just use the example. I've got $100,000 a year going in.
Yep.
I'm 10xing it. So now I've got $1 million a year that I put in. I get $1 million worth of tax deduction. I'm getting 5% of that $1 million. Right. So now I'm getting $500K in a dividend check every year from MassMutual or whoever I'm using, right?
Yep.
I can now take, let's say, $900K of that million out as a loan against the death benefit.
Yep.
Which would be, let's say, 5 million. Stick with that number.
Sure.
And I can reinvest that, go buy some real estate, and then make, let's say, 10% on the real estate, 5% on the insurance. So I'm stacking wealth now.
Yep.
So this is, I get all of that. That makes sense. What I don't still really wrap my head around is the replenishing side. So let's just say I take $900K out of my policy.
Yeah.
I know that that's compounding daily, right?
Yep.
Which is crazy when you look at those illustrations. How it doesn't even make sense to me because it's literally exponential curve. It's not a slow gradient.
Right.
So when you say replenishing, can you just break that down? I'm a 3-year-old now, not even 5.
Love it. You're gonna take that $900,000 policy loan. You're gonna buy that piece of property.
Yeah.
Most likely, it's already going to be a revenue generating endeavor.
Yeah, let's say I put 10% down. I put all $900K in. I bought a $9 million building.
Right. So then you're generating revenue from that investment.
Yeah.
You're going to take that $900K, and it can be in chunks, installments. It doesn't all need to be at once. It doesn't even need to be repaid ever. When you die, the insurance company will get, right?
It'll reduce it from the death benefit.
Correct.
So you don't have to repay it either.
Correct.
But if you did.
But if you're going to leverage it as an asset, then you want to replenish it because you want to do that again. So I'm going to take that $900,000, the first $900,000 from that piece of real estate, right? From that cash flow asset. And I'm going to repay that loan to myself on my policy so that there's no more outstanding policy loan.
Okay.
Then I'm going to do that again for the next property and the next property or the next business.
Okay. So I think I get it now. So what I'm effectively doing is I'm taking money out, putting my down payment in.
Yep.
And then now I own an asset that's cash flowing.
Yep.
So I can start repaying that deposit back. And as I'm repaying it, I can then take the next loan out.
Right. So
why wouldn't I just do more policies?
You could. We are limited, right? In how much life insurance we can take out on ourselves.
But you could do different life insurance companies or different trusts and so you could stack that too.
Yeah.
Right?
So if we're in trusts, and I mean, there are just different rules, right? As you know, we get to play by different rules when we're operating within the trust system.
Absolutely. Yeah.
Far more beneficial rules.
Well, that's what the elite use. That's
which is how they've kept themselves elite. So there you go.
It's never a level playing field, right?
Right. So with that advantage, we're able to leverage it over and over again. So I pay that money back with the cash flow from that asset, which reduces the loan balance, which makes that much more available for me to loan again.
Okay.
So we're replenishing that on a cycle.
I get it. So if I was to take another policy out completely, I would then be obligated to fund it the same amount every year.
Right, where you're paying premiums on another policy.
So it's better to flux the one that I already have. So I'm not again, depending on the financial situation, but
for sure.
I'm just trying to digest that bit because it always gets me confused. That last piece of, because in my mind, I would be like, well, I don't need to repay it because it comes straight off the death benefit. So my death benefit in this example was $5 million.
Right.
I've taken $900K out. All right. So I'm getting 4.1 or my family's going to get 4.1.
For them. I know.
Yeah. They can live with 4.1. But the point that you're making is you can keep reusing, keep replenishing and kind of keep flipping the money effectively, right?
I mean, leverage, success in business, success in investment, financial success is all three of those things. The core of that is leverage. It's leverage. leveraging the efforts of others, leveraging other people's money, leveraging a small amount of your money for a much larger asset. So that's what we gain in this tool is leverage. Now, as you pointed out, right, and as I brought up, you don't have to pay that loan back. So if you were going to take it out, use it, and just carry that loan balance, you're going to be paying interest on that loan.
Well, you pin it to yourself, right?
In essence, yes. But nonetheless, you have to pay that interest off each year, which is from the balance of the outstanding loan, or else it capitalizes and goes into your loan balance, and then you're getting compounding interest that you're paying.
Okay, we don't want
earning.
That. Yeah, okay.
We don't want to pay compound interest. We want to earn compound interest.
Correct. Okay.
So that's the key, right? So we flush that. We bring that policy back to flush from that producing asset, and then we do it again and again.
And this is really where you go from being rich to becoming wealthy.
Yeah.
Because now you use the word really well, it is leverage. You're leveraging your assets to produce more assets.
Exactly.
And then rinse and repeat.
Yes, sir.
This is how the banking system works. It's $1 in, they create $9 from every $1 that we deposit.
You would be amazed at the amount of bank-owned life insurance that's out there.
So let's talk about that. Let's dig into that.
Executives and C-suites at the bank.
Is that why everyone gets a VP title at a bank?
Or EVP or SVP?
I always wondered that.
VPs.
Is that because they can then put an insurance policy on those people?
It depends, right? I mean, but very much at the C-suite of every bank, you're going to find whole life insurance policies that are on the life of those executives, whether that's owned by the bank, right? That's an asset for the bank.
And it's a good sweetener to keep the staff, right?
Yeah. And it's sort of, golden parachute. You're going to get this when you retire. You'll get the cash value and there'll be some tax, but yada, yada.
So is that then same as what we're talking about in terms of the bank is using that as an asset?
You better believe it.
Oh my goodness.
This is an industry term. So this is so prevalent that it's an industry term. Bank-owned life insurance, BOLI.
Okay.
This is a very, very common practice. Insurance companies are doing the same thing, right? I know all the managing partners at, the big insurance companies and the C-suite executives for those companies, a part of their compensation packages, a whole life policy that's funded by the company. So,
and that's, okay. So that's definitely whole life. It's different to the variable stuff.
Correct. 100% different.
Wow.
Yeah.
See, that's a major nugget there.
Well, because they know the strength, right? They understand the strength and that comes out of the leverage of that asset. So it's no longer a liability. It is an asset.
This is literally changing your mindset on insurance doesn't sit on the balance sheet as a liability. It's actually up at the top with the asset section.
Right.
Because it's cash flow producing.
And the kicker on top of it, right, is, all right, $1 million cash value inside your policy. You're going to take a $500,000 loan to go put a down payment on that commercial property, cash flow asset. If you're with the right insurance company, which you happen to be, they have something that's called indirect recognition, which just means very simply, I'm earning dividends on the gross cash value, not the net cash value. So if I have a $500,000 loan, $1 million cash value, I'm getting paid a dividend on $1 million of cash value.
See, that's
even though I have a loan
deal,
outstanding.
right?
It's massive.
Because now you're not getting penalized for taking that cash out on the back end.
Right.
All the money you put in, you're getting a tax deduction and you're getting a full dividend.
Uninterrupted compounding of your wealth.
So explain that, the compounding, because most people don't really understand that. So can you dumb it down to a 5-year-old level on what compounded interest looks like compared to the alternatives?
I have small numbers. I have $100 of cash value.
Okay.
I earn a 5% dividend on that. That's paid into my policy. So it reinvests, goes into the cash value of the policy.
Okay.
I now have $105.
Over what period of time?
Let's say a year.
Okay.
That next year, my dividend is going to be based on and paid out on $105, not $100. So now instead of $5 for my dividend, I get $7.50, let's say, right?
We won't test you on the math.
I don't want to do the math right now. So that interest compounding just means interest on top of interest on top of interest. So my interest or my dividends are then earning dividends. So that's how it grows at such an exponential level once you get out, a few years.
And that's crazy to think, because we don't earn it like that in the bank, right?
No.
So how does it work in the banking system when we're...
A lot of times it's simple interest, right?
So
which
what
just
is
means
simple interest?
It's you're getting paid 5% of your initial balance. So if $100 was the balance of that account, you're getting paid 5%. You have $105 that next year, but your dividend is only going to be $5. It's going to be $5 every year,
single year,
because that's 5% of the $100. So that's simple interest.
It's a bit and swish, really, right?
That's a big difference, especially over time.
Especially as the numbers get bigger too, right?
They do. And that's where the compounding really benefits, right?
That's what, like, when I looked at my first illustration that I understood and it was explained to me. So, piece of advice: never just try and interpret these illustrations yourself. I'm a seasoned finance professional and I still don't understand them. Always sit with your professional advisor and ask them to dumb it down for you so you can get more value out of the time and effort that they've put in to building your illustration. I made that mistake way too many times.
Key. That's 100% true, right? Leverage the knowledge and the experience of somebody who knows more and has more experience than you.
It's back to what we always talk about in terms of team, right? Your insurance person is part of your team.
Yes.
They are an expert at this. If they aren't, you need to find a new one, but they should be an expert. That's what they live and breathe every single day.
Yes.
Let them explain it to you. Take the ego outside, leave it to one side. Just look at the numbers and assess whether that's good for you and your family or not.
Right.
And whether it's variable, fixed, or the million other things that we talked about in the middle.
Yeah.
You can then make a more informed decision. That's like the real key takeaway of everything I try to talk about is get enough information so you can make a better decision, whether that's CFO services, whether it's trust work, whether it's insurance. Principle is still the same regardless, right?
Absolutely.
So how do you help your clients do that? Because it is complicated. There's no shame in saying that.
No,
I get confused by that.
It is. I think one of like a point of pride for me is that I make a very hard point to ensure that the way that I explain it to them, a 5-year-old could understand it. Because as we add in all this complexity and this jargon and all of these industry terms, and people sort of just glaze over anyway.
All the time.
Okay.
Like,
so
I have the same thing every day with the trust stuff.
So me using all these industry jargon and terms and stuff that goes over their head, I'm talking myself out of a sale, first of all, because they're not really understanding me anyway. And when I'm making it overly complex, people are confused. What does a confused mind do?
It doesn't make a decision.
It does nothing.
Yeah.
It's like, I don't understand this. Okay, I'm not doing it.
Yeah.
So for me, sitting down and highlighting, okay, here's how much you're going to be, obligated to put into this policy every single year, or else the death benefit won't be there, right? You want to keep the policy in force. It is a life insurance policy, right? I mean, so part of the point is there's a death benefit there if I don't come home.
Well, that is the overarching starting point.
Right.
We're just using it at an advanced level where
Correct.
we get all of these consequences or benefits. Like, it's the same as a trust. We don't create our trusts for tax purposes.
Right.
It's for giving. It's for charitable purposes.
Yes.
Just the byproduct is tax savings and asset protection. And that's
Cream on the
perfectly
top.
fine.
Yeah.
Because it's playing by the rules that they set.
Correct.
We know clearly at the end of the day, it's all for charitable purpose. Whether that purpose is now, next week, or next year is irrelevant. But the way we're going to get there is systemized structure.
Right. And so that's especially when we're leveraging a whole life policy inside of a trust system for our clients, right? We're using it in such a way that it's extremely simple. You don't need a finance degree to understand. I pay my premium, here it is. The extra amount goes into the cash value. I can then leverage that cash value while I'm alive for business endeavor, investment, vacation, college. I mean, I don't care, you name it.
See, I really like the way that the interface is with Mass Mutual. Again, not plugging anyone, do your own research. But it simplifies it a lot. They're very good on the tech side of things where me and my wife can log into the portal.
Yep.
We can see, hey, we owe this much. It's automatically coming out.
Yep.
We pay ours annually.
Yep.
But then this is the death value. This is the amount we can pull out as a loan, and we can transfer it straight to our bank with a press of a button. They make it really easy for someone like me to understand it. So I really like that part of it.
And I kind of I get to help facilitate that, right? I get to extend that ease and that understanding, right? In the way that I explain it, the way that we deal with it.
You need that because I'm an accountant by trade, right? I'm an expert with numbers. I know how to read numbers, but even this stuff is like, woof.
Yeah.
It's next level with a lot of the terminology is different. The language is different. So definitely need people like you to help explain it to everyone, not just financial people, but even especially non-financial people.
Most people aren't finance people.
Yeah,
they're not.
See, I lose track of that because I'm just in my own little
Not
bubble.
Everybody's an accountant, you know, CFO, right? I think this is why at the end of the day, when we're talking about it, I'm not asking, how much money do you want to put in this policy? How much do you want? What do you want your cash value to be? I'm asking, what do you want to achieve? What's important to you?
What the outcome is.
What outcome do you want? Right? Because if we begin with the end in mind, then I'm going to reverse engineer that policy in such a way that it fits your financial situation and your goal sets.
Yeah, because the way I look at it is I can have cash sitting in a bank making me 1%, let's just call it.
And making them a ton.
Yeah, that is well. I'm trying not to think of that.
All right, different show. Sorry.
But I can make 5% if it's sat inside an insurance policy. So why wouldn't I just 4x my return just with one move? Let alone the other benefits.
Right. And it's that easy. And I think that you asked a question at the top of the show, why isn't everybody using it?
Yeah.
And what you just said is exactly why. Because it just seems it's too good to be true. This is so easy. I can get a tax-free dividend and I can access that money tax-free. And where's the catch? And there's a death benefit.
Yeah.
And I just pay this premium. Like, why isn't everybody doing this? Oh, well, there's got to be a catch.
Well, everybody is doing it.
Right.
In the right circles.
The people who get it or who have a team that gets it, right, that's helping them to execute these things, they're doing it because it's understood, the value.
It's so true, because even when I first got into the high net worth trust world, and it was like, well, why isn't everyone doing this? Honestly, come on.
I asked the same
way
question.
Too good.
Yeah.
But the real answer is the people in the right circles already are and have been for generations and decades. Like you look at the Rothschild family, the Rockefeller family, the Kennedys, the Buffetts, the Gates, all these families have been set up this way for so long. No wonder they have such an unfair advantage on everyone else. And then when you physically see the president or the ex-president of the United States tax returns being leaked and he's paying $750, I think most people are paying more than $750.
I pay more than that to have my taxes prepared.
There you go. So when a billionaire is paying $750, why are regular people paying more? And the answer really boils down to one thing. It's the team around you. You've outgrown your team. You need to find a team that can deal with a higher net worth type of client. And they're usually in family offices. Now, as we know, $5 million plus a year to run a family office, not everyone can afford that. And even if you can afford that, you still probably wouldn't want to do that for the vast majority of people. So you need to find another solution. The same as insurance, right? Is that not all insurance agents will know how to set up a policy in this manner,
right? Because
they probably make more commissions the regular way, right?
Well, it's, I mean, the more the premiums, the more commissions they make, right? And when I sell a larger premium policy or a smaller premium policy, I make a lot more, right? But at the end of the day, you have to be able to understand how to use the policy in this way. And you have to be able to explain it to people in a way that they can understand, that is simple and easy. And not everybody has that ability. Not everybody has that knowledge. And so I think, you know, the problem is that whole life has been used it's been oversold to the wrong people. And so it's caught a lot of bad wind or whatever, the negative press.
Okay.
And that just, it's unnecessary because they're just trying to sell more policies or make more commissions.
Doing a volume game.
Exactly.
That point, right? Okay.
Instead of actually digging down on the strategy of how to help people solve the problems that they have or achieve the goals that they have. That's been my approach since day one.
So it's a value first approach, I think is a really good way to summarize it. It's not about you. It's not about all of these hundreds of tools. It's about the client.
Yeah.
What does the client need, want, and the outcome?
Yes.
And then reverse engineering everything to fit that.
100%.
Okay. I think that helps a lot.
This is how the world's problems are solved. I mean, honestly, what do we want to achieve? Okay, let's begin with that end in mind and let's reverse engineer how to get there. And that's what we do every day.
That's awesome.
Yeah.
I love it. Okay. So let's wrap up. Thank you so much for coming. How can people get in touch with you? What are the best ways for them to do that?
You can find me, you go to my website, brandontrammell.com, 2 M's, 2 L's. Yeah. That's a great place. You can follow me on the major socials. I'm on IG and I'm on LinkedIn. And
you have your own podcast as well?
I do. Yes. Thank you for bringing that up. I'm a bad self-promoter. Yeah. So the Leave It Better podcast with Brandon Trammell. You can find the video version of that on YouTube on channel by the same name. Or
perfect. So what we'll do is we'll put all the links for all three of them below: the YouTube podcast, the website, and Brandon's IG. So click the link below, follow Brandon, show him some love because he shared so much with us all. Thank you so much.
Thanks for having me, man.